Folks, something we have to unfortunately talk about is the surprise rate move in the UK. They again came out last week with a surprise 50 basis point move. I want to talk to Taylor from Life Goal Investments and understand what the ripple effects were here in our bond market, because any surprise move from a central bank around the world will have impact here. And then more importantly, I want to step in the UK economy, UK real estate, because I don't have any good things to say. I think it was a wreck and it's now a catastrophe, what is going on over there. But let's start the conversation with Taylor from Life Goal Investments. How you doing, buddy?
Thanks for having me. As always, exciting. We're going to take our perspective and broaden it out a little further and look at the other side of the pond. So I'm excited
Absolutely.
for this. I think this is something that's been playing out now. Persistent inflation has been playing out now across the globe for the most part. So most places are either surprising higher or they're pausing and then going back higher, which is what we saw in Canada and Australia
Yes.
last month. And that kind of seems to be what's most likely as to what's playing out here in the States as well. Not the focal point of this conversation, but
Mhm.
again, that seems to be the most likely that June was a pause and July seems to be more likely that we raise again.
Yeah. Yeah. We'll get into that whole skip mentality in a minute because I think it's theater and pomp and circumstance. But
Yep.
hey, that's a different conversation. I want to
Yep.
talk about this because, again, I think what a lot of people need to understand is in a worldwide economy, a surprise move from a central bank, especially a 50 basis point move, will immediately impact over here. And what I saw happen was bonds go up. No, sorry.
God bless
That's what
you.
happens.
God bless
That's
you.
what happens when we do these live. So what happened on that morning was, I guess, rates went up, bonds went down. Now I think
Yep.
they changed or reversed later in the week, but any surprise move like that is going to probably weaken the dollar and it's going to impact our bonds. So talk to us about why that would happen, things like that.
Yeah, I think when we look at the global economy, the word of emphasis there is global, right? So
Mhm.
when we see that other countries are struggling with inflation, which is what caused them to have this surprise move higher in rates, and the velocity of rates went higher, the magnitude of the hike went higher at 50 basis points, we all take a step back and say, man, other people are experiencing the exact same thing we're experiencing right now, and this is how they're dealing with it. What's most likely to happen here? Because that happened there, and they have the same circumstances that we're playing out with. Maybe they're more severe, but nonetheless, they dealt with them by a shock higher in rates. And I think the market took a step back and said, uh-oh, what's going to happen in July here in the United States? And I think that's why you saw the bond market sell off, because if the Federal Reserve raises rates, generally what happens is bonds sell off. And that's exactly what the market anticipated happening when they saw that playing out in Europe, in the UK.
Again, I don't pretend to be a worldwide expert in the bond market or economies, but it does feel like the UK has a unique set of circumstances where inflation is persistently high and in the last report went higher, so it broke
Right.
trend, and they're in a pretty bad state. I think what they're doing, again, their central bank only has one mandate, and that's what makes the US unique with their dual mandate. And their job's to beat inflation.
Yep.
And when the inflation goes up, they raise rates. And unfortunately, their economy was already probably destined for a recession. And now I think it's guaranteed. And their housing market, given their debt structure is very different than the US, 30-year fixed rate debt is not a thing.
Correct. Correct.
They have families. I read an article over the weekend that about 1.2 million families are going to run out of savings by the end of the year because of the 50 basis point move, right? Discretionary income gone. Now they're
Yep.
dipping into savings to pay for their mortgage. So I don't know how the UK doesn't have a recession and probably a housing catastrophe. It's just feels like it's heading the wrong way.
Yeah, and to be clear, what Michael's referencing there is the UK has adjustable rate mortgages. They aren't
Mhm.
fixed 30-year like us, which is pretty unique to the United States. And it's actually unique to the United States since 2008. Since the Great Recession set in, there was a massive shift from, it was something like 40% of mortgages prior to 2008 were adjustable rate.
Mhm.
Now it's something like 2% of new issued mortgages are adjustable rate. And it's one of the things that when we look at here in the States and people say, hey, why hasn't the economy slowed faster with this rapid pace of interest rate increases that we've seen out of the Fed? It's because the biggest debt burden that everybody has, that is a homeowner, obviously, is
Mhm.
their housing component. And in the past, when 40% of mortgages were adjustable rate, and all of a sudden, I think it's something like 2/3 of the average person's debt is fixed in their home. So if 2/3 of your debt ratchets up from a rate perspective, obviously there's much more effect on your wallets, but now that's not the case anymore. And in the UK it is. And that's exactly what Michael's saying, is that they've ratcheted rates up. This is going to have a direct and immediate response on consumers' wallets, and that is going to slow their purchasing power, and that is going to spill over into their economy. And I totally agree with you that that is going to create a more dire economic situation there with that 50 basis point movement than it would here in the United States.
Yeah, and there's talk that they may not even be done, right? Because again, I think inflation there is over 8%. And
Right.
while we peaked at 9, I think they peaked at 10. And again, theirs went up while ours has been, I think, falling for 11 months in a row. So
And they're much more dependent upon supply chains and things like that. And obviously supply chains have loosened and gotten more amenable to buyers. But when you're, essentially an island, now it's a big island, don't get me wrong. I guess every continent's an island essentially, but you get what I'm saying there, where they're
yeah,
importing most of their goods. When you're not able to get them through supply chain bottlenecks as easily, that has a much more rapid impact on what happens from an inflationary perspective. Where if the United States shut down, all of our borders, we could, it would take some time, don't get me wrong, to process, but we could be relatively self-sufficient. We can produce agriculture, we can produce oil, we can produce almost everything. Obviously we bring in electronic goods from overseas, and that would cause prices to go up nonetheless. But UK has much less access to resources than we have. And therefore, again, when supply chains change and geopolitical risk picks up, it has a much bigger effect on their economy than it does here in the States.
the other thing that when I look at this kind of the worldwide impact, I think, and again, you're much more into this, I think the US started raising rates first and fastest, right? I think we did that quarter point, and then we had 4 successive 75s. And now I believe at least we're at the terminal rate. Others see 1 or 2 hikes coming. But I think we might see economies like the UK exceed us, right? We're right now 5 and an eighth, kind of the middle ground. We could see other countries up at 5.5 or 6. And what that might mean here is a weaker dollar. Is that fair to assume?
Yeah. Yeah. So, I mean, as rates go higher here in the US, it strengthens the dollar. So if you have rates going higher at a more rapid pace overseas, that could in turn, from an opportunity cost standpoint, weaken the dollar on the other side. Now I don't know, traditionally when you think about stocks like a weak dollar, right? It,
Right.
it creates better purchasing power for folks overseas to buy our goods. That said, I don't know that our stock market likes a weaker dollar against the backdrop overseas of significantly weakening economies based on inflationary rates going higher, right? If people don't have that accessible dollar to purchase whatever it is, our iPhone or whatever it might be, then that's not necessarily a great perspective either. For U.S. companies. So all things being equal, yes, stocks like here domestically, U.S. based stocks like a weaker dollar, and that is a very, very strong trend. When dollars weaken, U.S. companies generally do very well. But again, if it's against the backdrop, the reason for that dollar weakening is folks overseas can't afford to purchase our goods, then that might not look quite as rosy.
And then the last thing on the UK economy, and specifically real estate, specifically single family, I unfortunately see kind of similarities between what we had in 07, 08, 09, where we are having owners become forced sellers, right? What people don't realize is it was the mortgages that reset that became the reason to sell, right? Their
Yep.
mortgages went from $1,000 to $3,000, and it
Yep.
was affordable at 1,000. It wasn't at 3,000. And that just meant, the strategic default became a thing and people started walking away. I think there's going to be a lot of pain in the UK and people will become forced sellers. And unfortunately, what happens in this environment is you get a lot of forced sellers at the same time, which brings down asset values. And that's just a horrible feedback loop. So I think the UK real estate market could absolutely be in for a crash that's multi years in the making. And because once it starts, it feeds on itself.
Yeah, and it's a really good point that you make there, and you also used a great word there, a strategic disclosure or a strategic default, where people
Right.
make the decision like, hey, this doesn't make sense to hold on to anymore. I'm going to let it roll. There's also a massive outside of the economic rollover effect, spillover effect that comes with people defaulting on mortgages. There is also a massive, massive psychological perspective that ends up playing out there. The home is, from a psychological standpoint, the biggest value that someone has. And not even just psychological, that is the most valuable thing that most people own. So when that starts to topple and move downwards, that has a disproportionate effect on how people spend money. And one of the reasons that people have been so loose with spending money potentially here in the United States is the fact that home prices have gone up essentially 30% over the last 2 years. And that's caused people to feel extremely flush and go out and spend. That's going to be the exact counterpoint to what's going on if we do get this perpetuating downward spiral. And Michael's right. If you can't afford to own your home, you have to take a step back and say, what do I do from here? And sometimes defaulting on your mortgage, as bad as it seems, is the best option.
Yeah, we've talked occasionally about the wealth effect, and that is just consumers feeling wealthy, home
Right.
prices, stock market, whatever it is. But let's be clear, there is a negative wealth effect.
No doubt.
When families are scared, they won't spend. They won't spend. So um
It's an
yeah.
extremely sobering thought. It really is. As again, we see it to an extent here in the United States, but just to reiterate, the big differentiator there is that the home ownership is on fixed rate debt here in the United States. Your 30-year mortgage is not going to change. It's locked in. That's all but the entire portion of new mortgages that are issued. Overseas, that's just not the case. And that's in most countries outside of the US as well.
Yeah, we're truly very lucky. And then the last thing, I don't know the UK laws, but I know other countries. I don't know if you remember this, but in the United States, when somebody had a strategic default and walked away, they did not, that deficiency, right? Let's just say you had a 200K debt, the property sold for 150. There's that 50K delta. In the United States, that was eaten by the bank. The consumer was not held liable. There are countries, and I don't know if it's the UK, where that homeowner will carry that 50K debt or deficiency, as they call it. That is, again, is a very unique thing in the United States where we have 30-year fixed rate debt. And in most cases, you're not held liable for that. But again, go read the laws. I'm not an accountant or a
And
lawyer.
guess
So,
what that does here in the United States on the counterpoint to that? It takes the risk from the consumer and puts it on the bank, right?
yep.
And we're seeing some of the bank stresses play out because of that. Now, it's not exactly the same situation because, again, fixed versus floating, et cetera. But nonetheless, the bank risk or the consumer risk is transferred to the bank. And that's a lot of the issues that we're seeing play out in the regional banks right now are assets that they hold on their books that might not be good assets.
Yeah. It's really, I unfortunately, of the major economies reading what's going on in the UK, it really does feel like it's going to be pretty bad for a couple of years. Kind of Great Recession like, unfortunately, which was not a fun experience to go through. Um, there are opportunities to make some money, but there's going to be a lot of people that get hurt. It doesn't make me feel good to think about. So, Taylor, where can people find you?
Yeah, find us at Life Goal Investments. We put out daily commentary on both Instagram and on TikTok, just trying to make financial investing markets easier on people.
All right, folks, stay tuned for video number 2 because I'm going to come at Taylor about something that I think Wall Street presses that I just
Oh,
freaking
baby, let's
hate.
do this.
There you go.